The hardest lesson is don't always trust the smartest person in the room. I think there was a time a few years back when everyone was doing the floating rate debt and making all these claims and saying, oh, interest rates aren't going to go up. And like internally, it didn't feel right. And I was like, it doesn't seem like real estate can just keep going up forever. But a lot of people just said, oh, well, if so and so is doing it and they're the smartest one in the room, it must be okay.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this podcast and YouTube show, The Allocator, a brand new way to finance and invest in real estate. It's all about capital allocators and this new sector in the industry that has grown up over the last few years that essentially provide capital sources to sponsors through various methods. Now, my guest today is Amanda Larson of AmaX Equity. And Amanda comes from an engineering background, primarily in the oil and gas industry. And so she brings some really unique perspectives to the world of real estate. She talks about them quite openly and in detail. So you're going to find it very interesting what Amanda has to say. I met Amanda actually on LinkedIn, where she has probably the most entertaining, and I don't mean that in a kind of trivial way, but the most pleasant posts to follow and to watch there on LinkedIn. So definitely go ahead and connect with her there. If you want to know how to find her LinkedIn profile, just go to the podcast page at gowercrowd.com. I'll put a link there for you. Also a link to her website. And while you're there, please go ahead and subscribe to my newsletter. It comes out every week, and I am currently focused, apart from the usual AI, LinkedIn, and capital raising sections in my newsletter, I'm also focused on doing some investing myself in syndications this year. And so I'm sharing some of the lessons that I've learned over the last, I hate to admit it, 40 years or so in the industry, across all aspects of the industry. So if you're interested in joining me on that journey, go ahead and subscribe at gowercrowd.com. Okay, that is it. Amanda Larson, AmaX Equity, coming right up. Amanda, how nice to see you. Here we are in person, kind of, right?
Close
Having
enough. As close as we can get, yeah.
migrated from LinkedIn, where we've got to know each other a little bit. And
Mm-hmm.
I would love to know what you do for a living. And actually, what I'd like to start with, how is your company for AMAX Equity, AmaX Equity? How do you pronounce and
Yeah,
what do you guys
exactly.
do?
Yeah, it's Ama X Equity. Like exactly. So it's just the start of my name, Ama, and then X Equity. So it's all about multiplying your equity. It was almost too clever, I think, because it's not landing real well. So, but
That's all
yes,
right.
Ama
It's
X
good. It's
Equity.
unusual. It stands out,
Yeah.
which is good. So anyway, so what do you do and how do you make a living?
Yeah, so what do I do? Put quite simply is I help people invest in real estate who really are just busy with their lives and want to get into real estate. Maybe they're nervous about the stock market, maybe they want to diversify, maybe they like sold a house or something, maybe they're tired landlords, but I help them invest in real estate, primarily apartment complexes.
Right, but how do you
And
do that exactly? Not like what do you actually do to help?
yeah, to help them, I find opportunities and connect investors to those opportunities. And so I feel that need, like I oftentimes opportunities come and then I say, okay, this opportunity. Does it fulfill your need, what you're looking for your investment portfolio? And so I just connect people to opportunities
So,
and
so
help
what does
people
that
make
mean
money.
what does that mean to find opportunities? I mean, let's really dive into it.
Yeah.
Like I said, the season is all about capital allocators and capital
Yeah.
allocation, all that kind of good stuff. What does it mean to find an opportunity? Really tell me, actually, open the kimono and tell me what's
Yeah.
going on.
So what it is I get sent lists, I get sent deals from brokers. So apartment complex opportunities or apartments on sale from brokers, and then I meet with the brokers. I learn about the property. I go tour the property. I meet with property management. I underwrite it. I come up with a business plan and figure out if there's an opportunity there. And then if there is, I put in offers. I build a team, and then I have a business plan. And it looks like we have projected returns. We have what the opportunity might look like. And then I connect investors to that opportunity.
Right. So when you say you build a team, you've got a couple of examples on your website here.
Mhm.
One of them is the Derby at Steeplechase.
Yep.
So what's the story there? What do you do there?
So the story there, this is an interesting one. So the story there was I was touring this property. It was on and off market in Houston for quite a while. The seller wanted to sell, but didn't want to sell. They weren't getting the offers that they wanted. And I just stayed on top of this opportunity. I loved this property. It was in a good neighborhood. Like it was just a standout place on the block. And so I said, I really like this property. And I stayed on top of it and ended up getting my offer accepted. And when it came together to putting the team together, I reached out to a group that got me started in syndications and real estate investing, a group that I went to their meetup and was introduced to the whole idea. And so I had been following this group and learning from them, and they would kind of mentored me in many ways and gotten to know each other. And they partnered with me on this. And so they're a pretty well-known group out of Houston.
This is
And
disrupt equity you're talking about,
yeah,
right? Yeah.
yep.
So what is your role there? Did you sign on the loan? Do you manage the property? Like, how does it work?
So I signed on the loan, and then we use Disrupt has like another arm that they have, their Emerge Living, which they're involved with their property management. So we hire full-time property management. That's not my business at all. But I help oversee the property management. So once a week we get on asset management calls and have updates from the on-site team and keep an eye on occupancy, rents, vacancy, maintenance issues. And so really it's managing the business of the property. I guess is the easiest way to put it. It's happens to be real estate, but it's more about managing a business and making sure that it's operating effectively.
So how does that work then? You've got AmaX Equity, but
Hmm.
they have a press release saying that Disrupt Equity acquired the property. So how does that actually work behind the scenes? Who's buying it? Who's actually the principals on it? How does that work?
Because they ended up being the main principals, I guess. They brought in quite a bit of the equity, and I think every deal has a main sponsor and then a team that helps support it. And in this one, whilst I found the deal and I brought it to them, they were big enough to take it over. It's 260 units, so you needed a bit of some muscle behind you, and they had,
Right,
yeah,
exactly.
yeah.
Okay, so how did you structure that deal then? So you raised some of the equity.
Mhm.
What was the equity plan? I was looking at this press release, 31 million and change to
Mhm.
buy it. So how big was the equity on that? How much did they raise and how much did you raise?
So the equity on that, it was 75%. So 75% loan to value. So
Okay,
75% loan, 25% equity. I think the raise was around, it ended up being with all the construction and everything, it ended up being around 20 million. Um,
oh, the
we
equity.
needed to raise a little under 20 million. And so they raised a portion of that. I raised a portion of that. And then there's other sponsors on the team as well. There's three other people who helped
Got it.
raise
Other
capital.
capital raisers, other
Capital.
capital allocators.
Yeah. And
Ah,
I mean, they're all part of the team, so they help with asset management and everything as well, because it is a syndication structure. It's not a fund to fund structure.
right. Okay. So,
Mhm.
and then you cut deals with sponsors. So you have, did you get preferential terms then for your investors? Is that how it works in this case?
I would say no, because you'll find that more in a fund of funds model, and this is pure syndication. So we're all GPs on the deal, and so all of our investors have the exact same benefits as everyone else. No one is given preferential treatment.
Ah, I see. Because that's the model that I've been talking to folk about
Mm-hmm.
this series already is that they will negotiate preferential terms and
Mm-hmm.
then typically either keep the delta. So instead of an 8 pref, they might get a
Yep.
10. Instead of a 70/30, might get an 80/20. Then they keep that delta for their
Yes.
own compensation. So how are you compensated if you don't put it in that kind of structure?
So I'm part of the GP team as part of that. So I did invest as an LP, but as part of the GP, then I'm on the 20% GP split. Whereas if you do a fund of funds, you're not part of that GP equity.
What's the 20% GP split? How does that work?
So generally, you have the 80-20 split or the 70-30 split. And so 70% will go to investors, 30% will go to the GP. And so in a fund of funds, you're part of that investor split. You're part of the 70%, and then you skim off a delta that they give you.
Okay.
If you're part of the GP split, you have the back end, that 30% or 20% that only gets divided amongst the GP team.
Okay, so that 20%, and then there's also fees as well that come out of these deals, presumably.
There's an acquisition fee, which so I did get something up front, and that also generally exists in a fund of funds model. There is a asset management fee, and that goes to pay a professional asset manager, essentially. Um, I don't get any of that. Most of the time, it's a fee to keep the lights on, essentially, is what it is.
Right.
And then there'll be a disposition fee, I think. No, there's not a disposition fee. So just the acquisition and the asset management fee.
And so you get a share of what I would call the GP economics, so that
Yep.
20%, and then the five other capital allocators, they also get a small share. So
Yeah,
right, so but you have to wait for that
you
for a
do.
while. So how do you make a living on a daily basis
You do. So you get cash flow from the property, just like an LP,
as an LP though?
as an LP, but that's just like any other fund of funds. It's no different from a fund of funds structure. They only get the cash flow from the property, and then doing more deals every single year. And then waiting. So as these deals build up, you'll have a sale or two or three every single year. So it's really a long ramp up stage, to be honest.
Yeah. How long have you been doing it, Amanda?
So I started part-time a few years ago and full-time for a little over a year now.
Okay,
So
so no, you've not gone full cycle, obviously. And this one was this one, Derby. Let's see, Disrupt bought this Derby at Steeplechase in early 23. So actually almost
Mhm.
2 years ago already.
Almost 2 years ago. Yeah.
Right. Um, so you bought Kaplan after they closed the acquisition, did they? Did you?
No, you bring the capital in order to close.
In order to close. Okay.
Mhm.
Um,
Yeah.
so what made you decide to do this? This is an interesting, angle to play real estate. What appeals to you about this?
I think I mean, I don't know if it's an interesting angle. I think to me it makes sense. I owned some single family early on, and I came from a family that owns some single family and things like that. And always saw the opportunity in real estate, but never gravitated, never really enjoyed the landlord part of it.
Hmm.
And so when I discovered syndications, first of all, I discovered it as a passive investor. And so I could continue my career. I have an engineering and construction management background. I continued that, and I could invest passively. And so that was magic to me because I could own real estate. It ended up that I really enjoyed it. I really enjoyed the people. I saw there was a lot of opportunity there. I saw that if you could actually grow a business out of this. And with my background, I'm in the oil and gas space. And so it was a very volatile market. And I've been through numerous layoffs and always had this kind of on the back burner. And through my last cycle, I would call it, I was helped with the decision to go full time.
I see. That's by force, not by it was involuntary, right? But you know
Yes,
what? That's
but I think the idea was there to go full time eventually. It was the timing was probably sooner than I would have chosen. But there is a lot of opportunity in this space. And to be honest, I love what I do. Like working is not working to me anymore. It is, I really like this. I really want to build something out of it. It's business that happens to be real estate, I would say, in my view. So yeah, that's kind of how I see it.
so back to the Derby, or is it
Hmm.
pronounced Derby? I'm not sure which one.
Derby, but
Derby. That's
we can
stupid.
call it what we want. Yeah.
So the so the so the five capital allocators brought a certain amount of money in, and then as far as the share of the that 20%, was that pro rata based on how much money you brought in, or how was that
No,
decided?
it's based on a lot of different things. It's based on like, so for example, I sourced the property, so I did all of the due diligence and all the touring and met with it, got it under contract. So that's part of it. We put a lot of hard money down. So it's usually there's no usual, but it tends to be kind of 1% hard money you put down. So I was part of that, which I could have lost. It was a big risk if something happens and you don't close. So that goes towards the allocation. There's things like raising capital is part of it, part of the equation, but definitely not the full equation. Being involved in the review, like all of the due diligence process, doing the lease audits, um, inspecting everything. So everything that's involved gets kind of allocated a chunk of that 20%. And
I
so it's,
see. So that's a lot of responsibilities you've got. What do the other allocators do? It sounds like you do almost everything, and then you've got Disrupt Equity and their huge team as well over there.
yeah, I mean, everyone played a piece. I wasn't the only one that put up hard money. A couple of the other sponsors did as well. People were as involved as they wanted to be in terms of the due diligence process, like the inspections. So it really comes down to raising your hand. And if you want a bigger piece of that pie, it's, you know, put your hands in and do some work.
Do the work. Now
Yeah.
you said you
Yeah.
signed on the loan, which is a
Mhm.
big deal. That's a
Yeah.
big deal because now you can not just lose your invested LP equity, but you can actually go into Hock on a loan
Mhm.
as well. So, what was the process behind that, and why disrupt equity? What were the criteria that you look for in a sponsor that gives
Mhm.
you the comfort that they're a good person for you to be recommending to
Yeah.
your investors that they invest?
Yeah. Well, so they got me started in real estate, like syndications, and I had invested with them passively a number of times. I had brought them, I'd introduced other passive investors to them, and I just have of a lot of the sponsors that I know that they operate really well. I trust them. They're honest, in my opinion.
How do you
Just
verify that?
just
What
knowing,
kind of due
I guess
diligence do you do?
knowing them
Yeah.
for 5 years and knowing how their deals go, knowing that, you know, a lot of other investors that invest with them, talking to them about their other deals. I guess there's not trust is built over time, I guess you could say. You can do background checks and things like that. I didn't in this instance, but you can. And I wouldn't, it's something that I'd probably do with a lot of other sponsors just because I wouldn't have known them for as long. But with them, it was just trust and relationships built over time. And they helped me, learn and grow. And so I don't know if there's another way to explain it other than when you get to know somebody you trust, learn how they operate, you learn how they function, you learn, how transparent they are on their other investments. So as a passive investor, I saw how they communicated. I saw that they did share challenges and were completely transparent with operational challenges or opportunities. And so that's why I went to them.
So let me ask something. So you go out and you find investors. Oh, by the way, are you looking for other sponsors? Like what's the roadmap for you? Are you exclusively going to work with Disrupt or
No,
so how do you identify other sponsors? What's your process for doing that? What do you look for?
I look for their track record. In a lot of other sponsors, it would be I wouldn't have known them as long, so I'd probably do a background check.
Hmm. What would you look
Um,
at in terms of their track record? What are you looking for in their track record?
I like some full cycle deals. I like what
Any
they've been
numbers on that?
doing.
Like one full cycle, two full cycles, three,
If I'm
10,
gonna,
20? Yeah.
I don't know if there's a hard number. I would say a handful. I would say that I want to see what they've done recently. I want to see what they have done in the last couple of years. Now that the multifamily market has struggled, I think that there was a time where you got into the space and you bought and you didn't do anything and you were able to sell and make your investors a lot of money.
Hmm.
And I think those times are over. So I want to see what they've done recently now that occupancy is dipping and there are some, like, it is more challenging time right now to operate. So I really want to see what they've done in the last 2 years. I want to see what kind of loans that they are sourcing, if they're floating or fixed. There's no right answer there, I don't think. It depends on your risk tolerance and what you think the markets are going to do. Um, I want to see that they have capital available in case something starts to get more challenging, and I don't want to see capital calls on my investors.
How do
Um,
you determine that they've got capital available?
I would say their size is a big influence on that. Somebody who's sizable as opposed to five individuals coming together is going to be a different story,
Hmm.
I think. And
And what kind of size, Amanda, what does that mean actually?
if they have, I would say, that goes back to how many deals they've done. If they're an established, I would say, company and not a group of individuals. I think that's not the hard and fast line, but that's a good indicator. If they've been around for more than a few years and they've grown a company behind them, that's a good indicator. If they've done capital calls recently, or if you can ask, have they put up any of their own money to avoid capital calls? If they've done it in the past, they'll probably do it again.
Hmm.
If you have a company, you have a reputation to lose, and people will be willing to put capital in, just like I would be willing to put capital in before I would ask my investors to put capital in. Capital calls should be a last option, not the first, in my opinion.
So you have an amazing LinkedIn profile and you communicate extremely well on LinkedIn. Your photographs are absolutely amazing. I simply don't have the courage or the stamina to take so many pictures of myself. I'll just tell you, I've got, a couple of high school graduation pictures that are still floating around out there. But you do that really well. So when you go out, so now you're looking for you've described how you look for, what you're looking for in
Mhm.
sponsors. That's one thing. You're looking for deals,
Yeah.
your sponsors to establish relationships with. But you're also trying to find investors, right?
Yes.
To bring these two things together. So what
Hmm.
is your unique value proposition? What makes you stand out amongst
Hmm.
all the hundreds of other capital
Oh,
allocators that are coming into you and I both know it. We see it all the time.
yeah.
How do you stand out? What makes you different? What's your unique value prop?
So I think to start with, in my opinion, I think that there are some capital allocators that don't know what they're allocating capital to. Um,
What do you mean by that?
Like if I'm going to raise money, I want to be confident. I want to have underwritten the deal, understand the economics, tour the property, and I don't think I I'm not sure everyone does the same amount of due diligence. I'm an engineer by background. Raising capital is probably not my favorite part of the business. I really enjoy finding deals and underwriting and doing the finance business plan and things like that.
Mm.
And so I want to make sure if I'm bringing investors in that I know the ins and outs, that I can understand why certain decisions are being made. I want to understand why the price is the price. I want to understand everything about the market. And I'll go through all of that on my own independently. I don't ever take a pitch deck and hand it over to some investors and take it for what it is for face value, because I've seen that go terribly wrong. And just if I'm dealing with other people's money, I want to feel 100% confident that this is a good deal. And I understand that things can go differently than planned, but going into it, I want to feel very confident in it. And I don't think everyone does that. I also have,
How much have you raised so far in your new business at AmaX Equity in terms of investor
Mhm.
capital?
I've raised roughly 2 million. So still growing. This is, like I said, probably the piece of the business that that's hardest for me to gravitate to, I would say. So working on that side,
What
definitely.
do you think? What do you think sponsors look to you for the most? You go to an established sponsor, they must be looking to you for that equity raise, right? Is that
Mhm.
a big pressure on you to then
Yeah,
to go out and find it? Yeah.
yeah.
So,
And I
so
think,
what makes you stand out then? I mean, as uncomfortable as incidentally, it's actually my favorite
yeah.
thing.
Okay.
I actually love raising capital.
Yeah.
I've done it all my career. But what makes you stand out? How do you stand out? Okay, so you've told me in terms of due diligence and spreadsheets,
Mhm.
etc.
Yeah.
But in how do you articulate your value proposition online? I mean, I do love the stuff that you put on LinkedIn, by
Yeah. Well, I think there's few different ways I can answer this, but also I try to be approachable and have fun and answer questions in a way that people can understand it and make learning. There is a learning curve that every investor goes through, and try to make that as approachable as possible. Also, come from the oil and gas industry, and so I relate to a lot of people who work in the oil and gas space, a lot of engineers. I've got that same mindset. I know the challenges that they're having. I know what they're going through and there's all these cycles and how they have to survive those and how this can help them survive those cycles. The engineering background helps a lot, I think. Engineers tend to gravitate to this space. And I think I'm human. I think there's a lot of people on LinkedIn that put out nonsense and noise and don't don't connect with people. And that's my goal, is to connect with people and like build that relationship that continues to grow and build a community around my investors and not just bring investors in and then forget about them.
I think you're absolutely right that it's less noise and it's more blah. I think of it as
Yeah.
like everybody's gone to the same conference and downloaded the same templates and are just copying and pasting the same
Yeah,
ideas again and again. It's all very repetitive. And
it
that's what I
is.
was asking, what makes you stand out? Because being an engineer and
Hmm.
having that engineering mindset is really outstanding. And actually, maybe I'm wrong. I should go back with a different eye next time I look at what you post. But I didn't really get that sense, and it sounds like that's something that really is very powerful for you. And
Yeah.
when you talk about underwriting, this is almost rhetorical. I mean, we've not got much time to talk about it,
Uh-huh.
but when you do underwriting, when you look at a spreadsheet, when you apply an engineer's mindset to that, that's
Mhm.
extremely detail oriented. And
Yeah.
I don't get that vibe, you know.
Yeah. I feel far more comfortable in my spreadsheets than I do on social media. Like it's been a huge learning curve for me. You commented like now I put photos up. It took me a very long time to put a photo up. I used to just put charts and graphs and math basically is what I put up.
Really?
Analytics and
This was when you started
with LinkedIn
as a capital allocator.
as capital. And when I started using LinkedIn as a tool, so that's been fairly probably in the last 6 months. I've really
Okay.
started to use LinkedIn as more of a tool, and it took a really long time and a lot of I guess people urging me or how do I say it? Encouraging me to put myself out there more. And so now I put photos and I have fun and kind of goofy, witty
It's
comment
very
like,
cool. But you know what
yeah,
is miss? It's funny because you've kind of gone the whole other way.
yeah,
I would love to see some of your charts and analytics and spreadsheet stuff as well, because
hmm,
that is what really speaks to the real estate. You know what
yeah,
I mean? It's like to have a mix, but it's tough. You know, I constantly figure I'm constantly working on the blend of what shall I put out on LinkedIn. I'm
yeah.
like a constant evolution. For me, I'm like working on it constantly. I had podcasts going out on Tuesdays. This morning, I
Yeah,
decided, no, I'm going to do it on Fridays instead. And I want to do
yeah.
this and that, and the other.
It is finding that balance, and you kind of forget because LinkedIn gives you feedback, and sometimes maybe the feedback that you get isn't what you want. Like maybe views aren't necessarily what you want, but you actually want engagement, or maybe your spreadsheet isn't going to get as much engagement, but it's offering more value to the people who actually are digging into it. So,
Yeah.
mhm,
I mean, so my experience of this, not just LinkedIn, but in marketing in general,
yeah,
is that there is a vast, what I call invisible audience that is watching
mhm,
what you're doing, internalizing what you're doing, and not engaging at all. They
yeah,
are, for you, totally invisible.
yeah,
And so demonstrates, particularly in your case, the kind of diligence that you can put into underwriting, especially if this is something that you see other allocators lacking in, right? That just take somebody else's OM or pitch deck.
yeah.
And what do? Do they rebrand it their brand or they just send it out? Like, what do they do?
They stick their logo on it, and I mean, when I speak to some others, and I'm not saying everyone, I'm definitely not everyone is like this,
Hmm.
but there are plenty of capital raisers who don't know the first thing about underwriting, and I think that's terrifying.
Or about real estate for that matter, right? Well, that's basically it. Real estate is underwriting.
Yeah, yeah, and
Uh,
that's not everything, but I think it's important, and they don't, if you don't know what you're raising money for, I think that's, I don't know. I wouldn't feel comfortable with that. I need to know a lot more before I take somebody
Well,
else's.
you've also got to fess up as well that you don't know anything. Otherwise, you know, it's like the expression, like, so you're not fooling anyone. And if
Yeah.
you are, you're breaking the law, right?
Yeah.
Basically. So don't be fooling anyone, right?
Yeah.
All right, let
Yeah.
me, so LinkedIn, yeah, you're doing a really good job on that. I do encourage anybody to follow you on LinkedIn. I really love your posts,
And I get,
by the
well,
way.
your posts knock them out of the park. So I'm chasing you on the LinkedIn profile front.
Well,
So
you're very kind to say that, except I will not. I very, very rarely have pictures of me. I've got a mugshot. My podcast has my mugshot. I was a professional photograph taken about 5 years ago. But none of those cool things that you do. No, I love it. It's a personality and people. Amanda, people invest with people.
yeah.
That's
Yeah.
it. You know, that's the bottom line. Right,
Hmm.
look, so we're coming. Oh my goodness, 38. So let me wrap up with some rapid fire questions, if you don't.
Uh-oh. Okay.
Are you
I'm
ready?
ready.
Okay. So either in your world, you know, in terms of the deals you've invested in or
Hmm.
you've seen elsewhere, what's been the hardest lesson you've learned so far in real estate?
The hardest lesson is don't always trust the smartest person in the room. I think there was a time a few years back when everyone was doing the floating rate debt and making all these claims and saying, oh, interest rates aren't going to go up. And like internally, it didn't feel right. And I was like, it doesn't seem like real estate can just keep going up forever. Like something is not right. Like there's going to be a squeeze somewhere. But a lot of people just said, oh, well, if so and so is doing it and they're the smartest one in the room, it must be okay because who am I to know anything better or anything different? Um, and so I'm really glad that I do have one investment that's on floating rate, but like the Derby is on a fixed rate debt. And I'm really glad that the whole time I really stayed strong and I was like, I don't know, this doesn't make sense. Like something's feels not right about this. And so I learned that lesson just because somebody else is doing it, just because somebody is 10 steps ahead of you or 100 steps ahead of you or claims to be somebody else, they don't know everything. And they're probably just listening to somebody else also. So
That's a deep insight, honestly. So I'm just going to interject briefly. When I wrote my
yeah,
PhD, there's this one, or was doing the research using primary information. There's this one
yeah,
rumor about
yeah,
the key person in my thesis. I examined
yeah.
banking in the early 20th century, and there's this, kind of legend, and I actually traced it all the way to a single letter, an
Yeah.
actual letter that was written in 1905, and saw
Uh-huh.
how it had been misinterpreted. And everybody that talks about this situation all took the wrong interpretation of it. It's
Yeah.
absolutely fascinating because it's like it's an echo chamber,
It's
right?
it's people that are just parroting without understanding what they're saying. They're just saying the words without understanding what the words mean or what goes into the words or how they came up with the words. But there's a lot of that out there. And I'm really feel very strongly that if you say something, make a claim, you should understand it and you should really believe in it.
Second question. So, what have you found to be the most? So, as much as you don't like doing it, what have you found to be the most effective way of finding investors?
I think there's a few ways. I think there's two different pieces of effective. Ideally, you can meet somebody in person, but that's not ultra scalable and you don't always know if you're going to meet somebody at these events or not. So I find events really good because if there are people there that are potential investors, getting that one-on-one in person is invaluable. In terms of scale, it's things like LinkedIn, because people can get to know you, even though, like you said, they're sometimes hiding in the background. People can get to know you if you put your personality forward. And there are people will slowly come out of the woodwork that you don't even know were there.
Isn't that true? And so,
It
what kind
is,
of
it's
events?
kind of odd.
When you say events, like what kind of events would?
Networking events, any kind of networking. I almost find that real estate networking events aren't ideal for me, but things just like business networking events.
Uh,
Um, People are always wanting to make money. So anywhere that there's a high quality group of people coming together that might be interested in talking about investments, yeah, those are really great places to meet people and share and start to build a relationship, because one myth that's out there is that you can just go out there and talk about your deal.
mm.
But really it just starts talking about building relationship, maybe sharing a little bit about what you do, following up, educating, and just growing. It's all like it took me a while to recognize the importance of starting with your really like relationship, adding value, educating, and people will either eventually become interested and want to learn more, or maybe they won't, but that's okay. Um, but that's where it all starts.
What are the biggest? Well, what do you think makes for a successful capital allocator in today's environment?
I would say, oh, there's a lot of things, but more than just like almost anything that's challenging in life is just this willingness to stick to it. I think that there is a myth that it's easy, that anyone can do it, that you just go out there and start talking about deals. And for some people that works. Some people it comes naturally, but for a lot of others, it's just about sticking to it and learning from your mistakes and growing and taking feedback. And just sticking around, because people have to really get to know you and trust you and see that you've been in this space and get that time on your resume for people to trust you.
If you could go back in time to before when you started doing all this capital allocators, before you formed AmaX Equity,
Mhm.
what advice would you give yourself?
Ooh. Um, I would give myself the advice of be more willing to put yourself out there. Because even up until very recently, I thought I could be the be the operator and just spend all my time in my spreadsheet underwriting, touring, and not have that marketing muscle in me. But really, at the end of the day, everyone in this business, on some level, needs to be a marketer and learn how to market and sell and share opportunities. I don't even like the word sell, but it's more about sharing opportunities and be willing to put yourself out there. And it took me a long time to recognize that.
Right, because sponsors, I mean, primarily they look to you for capital formation. When you're working with a big shop like Disrupt, they've got
They
teams
have everything. Yeah. They have teams
already
of
in
people
place.
to do. Yeah.
Right.
Yeah.
Okay, last question. So, what's the biggest misconception, do you think, or the biggest challenges facing the capital allocator model? Whether it fund of funds or syndicator, but this kind of, capital allocator.
I think we're still going to see the biggest challenges. So up until a couple years ago, it seems to me that most people were doing the pure syndication model. And then because of some concerns people had with SEC regulations, I saw from my perspective, more people going to the fund of funds model. And I don't think we've seen everything that there's going to be like played out in the fund of funds model. I think that it's not the silver bullet that's going to solve all problems. And I think it's gotten even more people into the capital allocation space that maybe like they've flooded that market quite a bit and to solve a problem, but they're just making the problem worse.
Like for example, I mean, can you articulate what you think might be a flaw in the fund of funds model
So
that
I think
hasn't
the fund
yet
of funds
emerged?
model,
Mm.
yeah, so part of I think the SEC regulations were there is to make sure that people weren't out raising money that didn't know what they were raising for. And so I think the fund of funds model has made it even almost easier to do that. And I don't know how it's going to play out, but I think something, I don't know. I don't know. I think it's not the perfect solution. But I could be wrong. I could
I
be
like to
very
say
wrong.
that. I like to say I could be wrong. It has been known.
Yeah.
Well, Amanda Larson, AMA X Equity. What an enormous pleasure to meet you on this Zoom call. Thank you so much for joining me
No,
today.
thank you so much. I was delighted when I got the invite. I thought this is going to be a lot of fun because I really enjoy your commentary on LinkedIn. I know you just have a fun personality, so I knew it was going to be a good conversation. So appreciate the invite.
All right, that was Amanda Larson of AMA X Equity. Amanda, what a pleasure meeting you. Thanks so much for joining me on the podcast today. And I really did enjoy our conversation, our post podcast conversation as well. I hope you found the suggestions that I made about your website and positioning, etc., of value, actually. You're an impressive lady with an impressive background, and I would love to see more of that coming out on your website and also on LinkedIn. And thank you also, dear viewers, for joining us today. Really appreciate you being here. This show would be nothing without you. If you've not already signed up for my newsletter, it does go hand in hand with the podcast. They're at gowercrowd.com, covering all aspects of capital raising, AI in real estate, and particularly with a focus on my own journey to finding some deals this year to invest in personally, using the experiences and lessons that I've learned throughout my extensive career in this industry. Okay, that is it for this week. Thanks for joining me. Until next time, it's Adam Gower signing off.